After a stellar liquidity-driven run in Samvat 2077, experts are suggesting that investors should brace for a volatile phase for Indian equity markets in Samvat 2078. The market direction, they say, will be guided by a host of domestic and foreign factors that will keep the markets choppy. These include commodity prices and their impact on inflation and corporate earnings, policy stance of global central banks, especially the US Federal Reserve, a fresh wave of COVID infections, if any, global developments like economic recovery and China factors, IPO pipeline, and liquidity with retail investors. While rising input prices, especially those of crude oil and coal, have seen the markets trim gains in the past few weeks, analysts at Nomura have penciled in 0.6 to 0.7% rise in inflation over the next few months as a result of this. Sonal Verma, Nomura's chief economist for India and Asia, excluding Japan, said, "We estimate the impact on headline inflation to be as much as around 1 percentage point over the course of the next 6 months." As an investment strategy for Samvat 2078, instead of chasing index-wide returns, experts suggest investors look for companies with sound fundamentals, low debt levels, and revenue and profit visibility, given the multiple headwinds. Rupen Rajguru, head of equity investments and strategy, Julius Baer, for instance, expects the frontline indices to give a high single-digit to a mid-double-digit return in the next year.
Indian markets have witnessed a Teflon rally for the last 18 months. So while we are constructive on the equity markets, but we expect there will be some road bumps ahead in next 1 year. So from an index perspective, we expect a high single digit to a mid double digit returns over next 1 year, while the underperforming sector catching up that theme will continue. As far as sectors are concerned, we like the economy-facing sectors, so especially the banking and financial services. We are also positive on the recovery of capex, and hence we like sectors like industrials, capital goods, manufacturing, cement. Finally, we are also constructive on the export theme, so we like healthcare and large cap IT names. We also like specialty chemicals as a sector, but would wait for better entry points. Thank you.
Dhananjay Sinha, Managing Director and Chief Strategist at JM Financial, sees the Nifty between 16,500 and 18,500 levels going ahead. According to Krishna Kumar Karwa, Managing Director of MK Global, ample domestic liquidity will keep market sentiment buoyant despite headwinds. Global liquidity, however, could be at risk as the US Fed starts to taper.
There is abundant liquidity in the domestic ecosystem, as can be seen in the record inflow in the domestic MFs, the rising number of demat accounts being opened on a daily basis, as also the increasing market share of retail volumes on the bourses. Global liquidity could be at a risk as the US Fed starts to taper. In view of the prevailing low interest rate environment, we will continue to see domestic investors invest in equities. As far as investing in primary or secondary markets are concerned, money will flow wherever there are opportunities. Tech-led IPOs will continue to drive investor interest wherever there are no local listed comparables.
So while gains at index level may not be significant in the upcoming Samvat, investors should brace for a volatile phase in equities now, with good financial and operational performance by corporates getting suitably rewarded at the bourses despite headwinds. Talking of the market drivers for this holiday curtailed week, all eyes will be on manufacturing and services PMI data for India and the monthly auto sales figures, the outcome of US Federal Reserve meeting for cues on when the central bank plans to hike rates. On Thursday, the exchanges will hold a special Muhurat trading session in the evening to usher in Samvat 2078. Bharti Airtel, SBI, HDFC, IRCTC, Tata Motors and HPCL are some of the prominent companies that are scheduled to announce their September quarter results this week.
If you like this video, share it and subscribe to Business Standard. For more news, views, and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram, and LinkedIn.